The United States housing market crash is officially here. The United States housing market has been losing its wheels despite the Federal Reserve's rate cuts, and the severity of the problem came to the fore when the Commerce Department released its latest data. Most signs that the United States housing market is in trouble. Sales of new single-family homes in the United States fell in September by 0.7% to 701,000 units. The August reading also witnessed a downward revision to 706,000 units as compared to the original reported 713,000 units. But what's alarming is that the monthly price decline was the biggest seen since September 2014, despite tight inventories. A sign that a United States housing market crash is here. The median price of a new house slid 8.8% year over year in September to $299,400. The month-over-month decline came in at 7.9%. The drop in home prices seems a tad surprising given the tight inventory available on the market. The National Association of Realtors recently reported that in September there were just 4.1 months of existing home inventory. This was lower than the 4.4 months of inventory that was available a year ago and far lower than the ideal inventory level of 6 to 7 months. A warning sign for the real estate market is that the yield curve on United States Treasury notes has become inverted. That's when the interest rates for short-term treasuries become higher than long-term yields. Normal short-term yields are lower because investors don't require a high return to invest for less than a year. When that inverts, it means investors think the short term is riskier than the long term. That plays havoc with the mortgage market and often signals a recession. The yield curve inverted before the recessions of 2008, 2000, 1991, and 1981. Real estate markets could collapse in coastal regions vulnerable to the effects of rising sea levels. The Union of Concerned Scientists predict that 170 United States coastal cities and towns will be chronically inundated in 20 years. Another study found that 300,000 coastal properties will be flooded 26 times a year by 2045. The value of that real estate is 136 billion. By 2100, that number will rise to $1 trillion. At most risk are homes in Miami, New York's Long Island, and the Francisco Bay area. Higher interest rates have caused a collapse in the past. They make loans more expensive. That slows home building and decreases its supply. It also slows lending, which cuts back on demand. Overall, a slow and steady interest rate increase will not create a catastrophe. It's true that higher interest rates preceded the housing collapse in 2006. Many borrowers then had interest-only loans and adjustable rate mortgages. Unlike a conventional loan, the interest rates rise along with the Fed funds rate. Many also had introductory teaser rates that reset after 3 years. When the Federal Reserve raised rates, at the same time they reset, borrowers found they could no longer afford the payments. Home prices fell at the same time, so these mortgage holders couldn't make the payments or sell the house. As a result, default rates rose. The history of the Fed funds rate reveals that Fed raised rates too fast between 2004 and 2006. The rate was 1% in June 2004 and doubled to 2.25% by December. It doubled again to 4.25% by December 2005. 6 months later, the rate was 5.25%. The Fed raised rates at a much slower pace since 2015. The government's encouragement of broad home ownership induced banks to lower their rates and lending requirements, which spurred a home buying frenzy that drove prices up by 50 to 100% depending on the region of the country. The home buying frenzy drove in speculators who began flipping houses for tens of thousands of dollars in profits in as little as 2 weeks. During the same period, the stock market began to rebound, and by 2006, interest rates started to tick upward. Adjustable rate mortgages began resetting at higher rates as signs that the economy was slowing emerged in 2007. With housing prices teetering at lofty levels, the risk premium was too high for investors, who then stopped buying houses. When it became evident to home buyers that home values could actually go down, housing prices began to plummet, triggering a massive sell-off in mortgage-backed securities. Housing prices would eventually decline more than 40% in some regions of the country, and mass mortgage defaults would lead to millions of foreclosures over the next few years. The probability of a recession still hangs heavy as an October poll of over 100 economists by Reuters revealed that there is a 35% chance of a recession in the next year, even if there is a trade deal between the United States and China. In the end, it can be concluded that a combination of weak inventories, tepid wage growth, recessionary conditions, and a sliding sentiment is about to send the United States housing market into a tailspin despite a feel-good third quarter report. Schiller's not the only one concerned about a United States housing market bubble. The number of experts waving caution flags has increased dramatically over the past month. Some point to fallen new home sales despite tight inventory as a sign that the housing market is already starting to crash. Fannie Mae's October sentiment indicator showed a 2.7-point decline, suggesting that Americans are starting to worry about shelling out for a new home. A research report by online real estate firm Zillow showed that nearly half of the real estate experts and economists it polled saw a housing market recession hitting the United States in 2020. United States households are now sitting on a record $14 trillion in mortgages, credit cards, student loans, and other forms of debt. Household debt ticked up 0.7% during the third quarter, the New York Federal Reserve said on Wednesday, continuing a 5-year climb encouraged by low employment, strong consumer confidence, and cheap borrowing costs. Consumer debt is now about $1.3 trillion, higher than the previous peak set in 2008. Although these figures are not adjusted for inflation nor the larger size of today's economy. Household debt has climbed about 25% from the post-recession low of $12.7 trillion. Mortgages remains the largest chunk of Americans' debt, accounting for $9.44 trillion. That's up by $31 billion, or 0.3% from the end of the second quarter, according to the NY Fed. 20 risks to markets in 2020. Continued increase in wealth inequality, income inequality, and healthcare inequality. Phase 1. Trade deal remains unsigned. Continued uncertainty about what comes after Phase 1. Trade war uncertainty continued to weigh on corporate capex decisions. Ongoing slow growth in China, Europe, and Japan, triggering significant United States dollar appreciation. Impeachment uncertainty and possible government shutdown. United States election uncertainty, implications for taxes, regulation and capex spending. Antitrust privacy and tech regulation. Foreigners lose appetite for United States credit and United States treasuries following presidential election. MMT-style fiscal expansion boosts growth significantly in United States and/or Europe. United States government debt levels begin to matter for long rates. Mismatch between demand and supply in T-bills, another repo rate spike. Fed reluctant to cut rates in election year. Credit conditions tighten with more differentiation between CCC and BBB corporate credit. Fallen angels, more companies falling into BBB and out of BBB into HY. More negative yielding debt sends global investors on renewed hunt for yield in United States credit. Declining corporate profits means fewer dollars available for buybacks. Shrinking global auto industry, a risk for global markets and economy. House price crash in Australia, Canada, and Sweden. Brexit uncertainty persists. According to a recent survey by the National Association for Business Economics, 74% of economists polled believe a recession will hit no later than 2021, citing risks associated with United States President Trump's economic policy. The polled economists believe that the economy is already at risk. What happened in the United States always has spillovers effect on Canada, so if the forecast United States recession materializes, Canada will likely enter one as well. If you think this sounds worrying, you wouldn't be alone. But the United States still has one great strength: the American consumer. I cannot think of a time when the United States consumer has been in a shape, said Federal Reserve Governor Richard Clarida in September. Debt levels relative to income are at their lowest in 40 years. The savings rate is high, and real consumer spending is growing at a rate of almost 3%. Recessions tend to catch economists unawares, and the ones they do see coming often don't happen at all. A few years back, many forecasters circled 2020 in their calendars as a likely time for a downturn. Mark Zandi, chief economist at Moody's Analytics, warned in early 2018 that 2020 is the real inflection point. It's going to take some real good policy making and some luck to avoid a recession. Back then, Carl Riccadonna, Bloomberg LP's chief United States economist, also predicted that the economy in 2020 might be poised for a bumpy ride. With United States interest rates no longer at rock bottom and the sugar rush from the Trump tax cuts all used up, the fear was that the recovery might simply hit a wall. Instead, it has run into a thick fog of policy-induced uncertainty that's making it difficult for businesses to plan ahead. But the private sector is still adding jobs, and the almost 80% of the United States economy that isn't bound up with manufacturing and global trade is growing at a decent clip. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.